Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 16th of October. I'm Daniel Lam, your host for the podcast. A few weeks ago, we spoke about how investors must act when there is a clear regime change. I even went as far as saying that to do nothing in such scenarios is just as bad as making big errors. Well, the beginning of the Fed rate cut cycle is a major regime change, and once again, there will be increasing talks about the hunt for income in the investment community. Recently, there are opportunities to be adding to fixed income because the US data has been strong. For example, the latest non-farm payroll resulted in a powering back of the Fed rate cut expectations. US inflation in September was higher than expected, while minutes from the Fed's last meeting show policymakers were divided on the outsized 50 basis point rate cut in September. The policy-sensitive 2-year US government bond yield rose by more than 30 basis points, while the 10-year yield rose over 25 basis points since the jobs report. So this raises the chance of just 25 basis point rate cuts in each of the remaining 2 meetings this year. The market is pricing a total of 140 basis points of Fed rate cuts over the next 12 months versus 175 basis points before the September jobs report. Now, we would average into bonds to lock in higher yields over the longer term. The US 10-year government bond yield surged above the 4% mark, making the risk-reward profile of US government bonds more attractive than a few weeks ago. We see good resistance level for the US 10-year government bond yield at 4.17, followed by 4.3, and our 3-month target range for the 10-year US government bond yield is 3.5 to 3.75%. Now, the key risk to bonds is a Republican sweep of the White House and Congress in the elections, which could lead to higher fiscal deficit. This is a topic that we spoke about in yesterday's podcast. Moreover, a dramatic surge in oil prices due to any disruption in supplies remains another risk. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.